Hello, everybody. Welcome to RealWealth's weekly webinar. This is a good one. There's actually four of us, although you only see three. We've got Leah in yellow, Aristotle in blue, Ben in green, and Joe couldn't find a primary color shirt, and he got into a really bad bar fight last night. He got a big stinger, and he doesn't want to talk about it, so we won't bring it up again. But Joe, say hello, Joe.
Hello, you should see the other guy.
All right, so welcome to Investing in Real Estate in 2022, what all of us, your investment counselor, wants you to know. Today's January 13th, 2022, and the last time we did this, it was really well received. So we're happy to do it again, and we're happy that you're here with us. So let me go over today's agenda. Each one of us has a section and a topic. So the first one is, what does it actually mean to buy and hold? We're going to talk about that. Top 4 investor questions of 2022. We're going to talk about rising rents, and a lot of people are happy about that, but it also worries them at the same time. We'll kind of discuss that a little bit, and just looking at the bigger picture. What is it like to invest in 2022 as opposed to, I don't know, 2012? Well, they're very different worlds. Does that mean you should sit on the sidelines and not invest, or should you continue to move forward? And obviously, we're all pro real estate, but we think you should move forward, but you got to do whatever's right for you. We'll talk a little bit about that also. All right. One thing that we thought would be a good idea is just talk a little bit about RealWealth investor successes in 2021. Seems to be it's actually somewhat justified. Leah, I think you got an email the other day from someone saying, why are you promoting? There's nothing available. There's this overall idea that there's nothing available and inventory is so tight and nobody has anything. Well, inventory is tight, especially when you're looking in the rearview mirror and comparing it to previous years when it was the exact opposite scenario. But that does not mean that people aren't closing, buying, finding, renovating, fixing, flipping. Everything is still moving along forward. It just might not be quite at the volume that some of us are used to seeing. So what we wanted to talk about is last year, 2021, year just ended, RealWealth members bought 650 properties. So, what is that? How many is that per month? 650 divided by 12, 54 properties a month. So, I've been around working with RealWealth since 2014. That's about the average. So even though inventory is tight, and it is, it really hasn't slowed down that much within the world of us and our members. So I think we break it down. Let's break it down by markets. In Florida, 224. So that's the lion's share. It's more than twice as much as market number 2, which is Ohio. And Ohio is one that where, there is a big difference buying in Ohio from now to 5 or 6 years ago when there was 20 properties a month. Now it's more like 3 or 4 properties a month, but it still added up to 104 for the year. Texas, 83, Maryland, Baltimore, one of our newest markets, 73, 56 in North Carolina, Alabama, 29, Indiana, 11, and Detroit, Michigan, 10. So there you go. It's still happening.
I want to point out that Florida is so high because we have 3 teams there. And for a while we actually have 4. So there's that too.
Absolutely. Yeah. That looking at it just from state by state is a little unfair in that everyone's hot on Florida. And for good reason. And we've got 3 teams here. So yeah, absolutely. Good pointing that out. All right. Past, present, and future. Let me go back and explain this a little bit. So what we thought would be a good idea is, I've been doing this with RealWealth since 2014, but I've been kind of a real estate investor on the side or full time, but mainly on the side for almost 30 years. It just kind of scares me when I think about it. And so we just thought, Ben, why don't you go over some of the properties that you've bought in various markets, and not so much to toot my own horn or toot my own horrible mistakes, but more so just to kind of point out that it continues to happen in good, bad, and indifferent markets, past, present, and future. So I've got this one here. Walnut Creek, California. I was in college, and a friend of mine and I were tired of the fog of San Francisco, so we moved to Walnut Creek, rented a house, And the old couple that owned it were like, hey, would you like to buy it? We'll sell it to you on a lease option. We'd never owned anything before. We're like, you know, compared to how much it would be to rent to how much it would be if we bought it and how much our mortgage would be. Anyway, long story short, I think that was about 1991, I think. So bought the house for $239,000. And then maybe it was earlier than that. Maybe it was in like 1988. I don't know, whatever. For whatever reason, the Bay Area hit a big rough patch and the house went way down in value. And I remember 150 is a little bit of an exaggeration, but it went down to like high hundreds. And I remember being kind of like bummed because the identical house 3 doors down sold for like 180 or 182. And I was like, oh, you know, all bummed about it. Well, so what? My mortgage was still the same. And we ended up keeping it for a few more years. The big saying at the time was stay alive till 95 when the market will recover. And sure enough, it did. And we ended up selling it for, like it says there, 650. So it's just a matter, you know, just gotta hold on. Yeah, it was kind of a bummer knowing that I was underwater for a few years, but I mean, so what? You just had to kind of just write it out. So that was just one example that I thought would resonate with Californians. Maui, Hawaii. Never owned anything in Hawaii, but I worked for this company that wanted me to relocate there. I was a regional manager for a hotel audiovisual company, and they're like, "Hey, we need somebody to go to Hawaii and oversee Hawaii." Because I lived in Walnut Creek and I was paying a mortgage for a house I bought for 240, it was really difficult for me to justify moving to Hawaii, buying a house. I mean, yeah, I could have rented, but whatever. I wasn't considering that. Buying a house, and I would have had to spend about 650 was the going rate for a, you know, a modest 3-bedroom house in Maui. And I'm just like, owning a house that I paid 230 for is working against me mentally because I'm going to have to pay 3 times higher of a mortgage every month. So anyway, long story short, didn't end up moving there. Too big of a leap in many different ways. And but I actually just went back to Hawaii a couple weeks ago, first time in like over a decade. And if I had bought, I have no idea what house that was, but if I had bought whatever that house that was for 650, it'd probably be worth 1.5 million now. You know, so it's like I couldn't swallow the pill at the time, but if I'd swallowed the pill at the time, I'd probably be a happy camper at this point. You know, so that's just another example. Newport Richey, Florida, got a triplex. Doesn't look nearly as nice as this one here. It's a little bit dumpier than that, but bought it for 165. I don't think it's worth 650, but it's just gone nowhere but up, and it's probably in the high 3s, maybe low 4s, and I expect that it'll eventually get to 650 by just holding on to it. So, I mean, and going back to that Walnut Creek thing, there were a few times where we're like, oh, let's get out of here. You know, we turned it into a rental. It barely cash flowed at all. We had to subsidize it. It was built in 1955. So there were issues. So there are plenty of times when I thought about just cutting my losses and getting out. And I'm just obviously really glad I didn't. And so I think the bigger point is you have to kind of resist the temptation to bail early, because in most cases, it ends up paying off just by holding on. Okay, Phoenix, Arizona. So 295, 350, 650. Actually, I'm going to change those numbers around. I got a short-term rental, the only STR Airbnb property I have. Bought it for low 6s like a year and a half ago, July of 2020. And if I haven't gotten into praise, but I get these Zillow reports, as you do with anything that you own. You type it in and Zillow takes it upon themselves to send you reports every once in a while. And if you sold it, you're all annoyed at those reports. But if you still hold on to it, you're happy. And the property that I bought for 619, Zillow says it's now worth 902, and it's only been a year and a half. That's an anomaly. It's Phoenix. They've had a couple huge years, but you know, it's just another, like, you know, it's not that good of a monthly cash flow property, but it's a great appreciation play, long-term hold. Oh, here it is. That's the one I meant to mention. There it is, 619,902. So summary, I guess here's the overall point that I just kind of want to make, because a lot of people that I'm sure all of us talk to is, they're like, have I missed the boat? Is it too late? Should I, damn it, if only I'd done something 2 years ago. But the thing is, whenever you buy something, not whenever, but most of the time when you're buying something and you're scrolling through RealWealth's site and you're talking to the various property teams and you're looking at the pro formas that they have, you're like, what's 162 cash flow? What happens if this happens or that happens? And it's really easy to talk yourself out of something because the numbers aren't that good when you compare the ROI and you look at the cash flow and you have a memory and you remember what they were a few years ago. But what I think people forget is that the numbers are the worst, most likely, not guaranteed, but most likely the worst right now. And that your costs for the most part are going to be fixed because you've got a 30-year fixed loan. Taxes, insurance may fluctuate, 10 or 20 bucks, $100 here or there, but for the most part, your cost is fixed. Meanwhile, the price of the property is going up and the rents are going up. And so that cash flow amount, while compressed now, will get better and better and better. Now, there might be the occasional momentary dip or whatever, but the overall trend over a long period of time is to be better. And almost without exception, actually without exception, every property that I've bought, whenever it was, if I look at it and I still own it, I'm like, oh my God, that's nothing. Like the Jacksonville property I bought for $102,000 with a $613 mortgage every month. And the rents have gone up and they've, 900 and 1,000. The 2-year tenant just moved out. They're going to renew it at 1,200. And I was like, that seems awfully conservative. And they said, well, yeah, that's the low end conservative number. It might actually be 1,400. So my mortgage is still only $613 a month. So it's just, I think it's being a little short-sighted, and it's human tendency to look at what numbers used to be and talk yourselves out of buying something now because you think some catastrophic thing will happen and the numbers will suddenly become like they used to be yesterday. Well, I doubt that'll happen. Maybe it'll retrench a little bit, but if you sit on the sidelines decade after decade or year after year, then you're just missing the boat. And it's like people think that's a low risk strategy, but whenever you talk about risk, you have to consider the risk of things you didn't take. What about the risks not taken? What risk is that to you? Because the value of money keeps going down relative to what it used to be. So anyway, that's the moral of the story, that don't let yourself get caught up in the current numbers when the current numbers are current, but they're only the numbers current. They'll get better, most likely, over time.
Yeah, it's really hard, Ben, to quantify opportunity cost for most people. We can look at a pro forma and we can quantify, cash on cash returns from this year to last year. But we don't at the same time quantify the opportunity cost of not having invested in that last year. And you should be just as concerned with that as you are about what this property could do going forward.
And actually, thank you, Leah, because I'd forgotten what that expression was and I fumbled it earlier. But whenever you're looking at risk, you have to measure the risk of opportunity lost. That was it. It's like, okay, you didn't take that opportunity. What risk is that? Because had you taken the opportunity, you'd have this benefit. And by not taking it, so people just forget that.
Ben, I'm curious, question real quick before you go to the next one. How many deals have you passed on? Well, it's harder to say. I guess I should say it this way. Do you have any deals that you have now that you regret buying? And are there more of those or less of those than the deals you didn't buy but wish you had bought?
You know what? Remember when I was talking about I will answer, but here's the vacation property. This is the one that I regret selling because I bought the thing at $295, sold it right after the economic downturn. It had started to recover a little bit. It was a unique property, very hard to rent, also in Phoenix, at the top of a hill. Just hard to rent, and I'd had a series of mediocre tenants. I'm just like, get rid of it. And like now I get those annoying Zillow reports and it's like up in the sixes, and it'd be a perfect Airbnb. It had a view of the city, it had a pool, and just like, so was the question like, is there anything that I wish I'd bought that I hadn't? Oh, you're muted.
Yeah, or vice versa. I mean, in my mind, it's like there's more deals that I passed on. There's more deals that I passed on that I should have bought, and fewer deals that I did buy that I regret buying. Even the ones that haven't done very well, I'm like, okay, I still learned something. It did okay. So yeah.
Yeah, there are definitely quite a few. I mean, the problem is a problem that I have. It's not really a problem, but like this house that we're looking at here. Yes, I sold it for 350. Yes, I regret not buying it, but I don't have unlimited funds. I don't have, money sitting around in bank accounts. And that property sold at the time allowed me to in turn buy like 2 or 3 others or whatever. So if I had held on to that property, I wouldn't have maybe 1 or 2 or maybe 2 or 3 others. So it's hindsight's always 2020, but there were advantages to selling it in that it allowed me to buy maybe that triplex in Newport Richie that I mentioned on an earlier slide. If I hadn't sold Phoenix, I wouldn't have gotten that. So it's like I'm trading one for the other. But yeah, there are definitely deals that I wish I had got. In fact, that triplex was through our Tampa property team that we still have with a different name, and they actually had a triplex and they had a duplex, and they were kind of packaging them together and selling them together. And I got the triplex, which I still own, but I didn't do for whatever reason, didn't have enough money or whatever. And sure, I wish I'd done them both, coulda, woulda, shoulda. If only I had, $5 million in cash sitting around, I could do a lot with it. But yeah. Anyway, so let's see where this goes here.
So I believe Joe's next.
Yes. Hello,
So
everyone.
Joe, how's your eye?
Oh, it's fine. Hello, everyone. This is Joe Torre. I apologize for the technical difficulties. For some reason, the webcam that worked perfectly yesterday is not working at all today. So I'll be the voice behind the curtain, but I'll have my slides here and you can focus on those. Today, I want to talk about some top questions I get from investors when talking with them on strategy sessions. And if you go to the next slide, I think there's a list of them that I'm going to go over. So these are questions I get all the time. Where are interest rates headed in 2022? Will home prices continue to rise? Because we've had quite a run up in the past year. What effect is COVID going to have in the coming year? And my favorite, are we in a bubble? I get that one all the time. So I'll address each of these and give you my take on these questions. Let's go next slide. So as far as interest rates, short answer is interest rates are expected to go up to the chief economist at the Mortgage Bankers Association. I watched a presentation he gave 2 weeks ago. He's expecting to go to 4% for owner occupants by the end of the year, which is kind of a gradual increase. And of course, for an investor loan, it'd be a little higher, maybe 4.5%. And we know this because the Fed has specifically said they're going to start raising interest rates 3 times. They hope to do it in 2022. And also, the Fed is scaling back its purchases of mortgage-backed securities. So this is going to have the effect of interest rates going up a little bit for investors. Next slide.
Sorry.
So the effect this is going to have is slightly more expensive monthly mortgage payments. And I did some math back of the envelope. So if rates go up by 0.5 percentage point, 50 basis points, that will only add about $30 a month for every $100,000 you're borrowing. So it's a little bit of an increase, but it's not catastrophic. Another effect we can expect is faster loan processing. For a while there last year, it was really hard to get a loan, an investor loan process. It took like 30 days. The reason being that interest rates were so low that a lot of homeowners were refinancing their primary residences, and all of our lenders were backlogged. So as rates increase slightly, the refinancing side of the business should dwindle away. And in fact, by this time, anybody who wanted to refinance has probably done it already. So as that goes away, it'll be easier and faster to get loans processed for your investment properties. So the bottom line on interest rates is they are going to go up a little bit this year, we expect, but it's not going to be a big deal. Okay, next slide. All right, will home prices continue to rise? Short answer is yes. Last year, prices in select markets went up by about 15%, which is huge. And you can't do that every year because eventually first-time home buyers will be priced out of the market. So the head of the Mortgage Bankers Association is expected prices to rise about 6 to 7%, basically half as much as last year. But that's still pretty good because if you put 20% down and your property appreciates 6% in 1 year, well, that's like a 30% return on your money on your down payment. So that's still a great return. So what's driving that, as always, is supply and demand. So we have 72 million millennials who are entering household formation age. That's the largest demographic cohort in the United States, bigger than the baby boomers. So that's a huge amount of demand. At the same time, there's a shortfall in supply because after 2008, home builders scaled back their building of new homes and lenders wouldn't lend. So a lot of homes that should have been built weren't. And so nationwide, we're expecting the projection is that there's a shortfall of 6 million homes that we should have, that we don't. And then, of course, low interest rates are contributing to that. It's keeping demand very strong. The other factor is building materials are getting more expensive. As we saw last year, there was a lot of shortages of various building materials like lumber, windows, appliances, and labor. This year, it's expected to be less worse, but it'll still be a factor. And as always, all real estate is local. Hot markets like Florida and Texas might rise 6 to 7%, but that doesn't mean Toledo, Ohio is going to go up by that much. You have to look at supply and demand conditions in your market. So if you go to the next slide, we can see what effect this will have on investors. It's still a good time to invest for equity growth because supply and demand conditions are very favorable and bullish for housing, and it's not too late. Don't feel like you've missed the boat. There's still a lot of runway for this trend. 6 million homes, they expect it to take somewhere between 5 and 10 years to catch up. So that's a long runway for future growth. Okay, next one. Well, what effect is COVID expected to have in 2022? So overall, the effects of COVID are diminishing. I got to do my own slides next time. What we're finding is that every time there's a new variant, each one is having less and less impact on the economy. That's not to say impact on the healthcare system, which might still be overwhelmed, but on the economy, it's having less and less impact. Businesses and employees are kind of learning to work around it. And I was watching TV the other day, and Dr. Scott Gottlieb, the FDA commissioner, says that he expects it to be like the annual flu shot, where every year around wintertime, you just get another COVID shot for whatever the latest variant is, and just keep moving along because it'll just become routine. But there's some interesting side effects to COVID. If you go to the next slide. All right, number one is surprising. Underwriting risk might increase because more people are switching jobs or being laid off because they're not vaccinated. So think of it from a standpoint of a lender. The Biden administration right now is trying to get a vaccine mandate approved. And the conditions are that if you work for a company with over 100 employees, you have to get vaccinated, or you'll lose your job, or you have to pay out of pocket for a COVID test every week. So that can, if you're a lender and you're lending to a borrower who might be in that situation, that introduces some risk. So we might see the day, we're not seeing it now, but it might come to, when you're applying for a loan, you might get asked, have you been vaccinated? Do you work for a company with more than 100 employees? We don't know if the Supreme Court's going to strike that down or uphold it, but this is something investors should have on their radar, keep an eye on, because that might complicate your borrowing process. Another thing which we've seen even last year is that COVID is affecting the types of homes that are in demand. More people are wanting 4-bedroom homes because they need a home office because they're working from home, and a larger living area because a lot of times they have to homeschool the kids because the kids aren't in school anymore. They can't go to school. So a larger living area and more bedrooms means a bigger house, which means it's more expensive. So we expect also to see the trend where more and more people are buying and renting further away from the urban core. because the larger home is more expensive, so you can't really buy it close to the city because it's too expensive. But the ability to work remotely enables you to move further out and still work. All projections I'm seeing about what will the world look like after COVID are predicting a hybrid work model. No one's saying that we're going to go back to the way it was before and everybody's going to have rush hour traffic and go to the inner city and work downtown in offices. Everybody's expecting you work from home because businesses and employees have figured out that you can work from home and have no problem. And so that's going to continue. And maybe one or 2 days a week you drive into the office, but for the most part, you can still work from home. So this gives us a lot of flexibility as to where houses can be located and where renters are willing to rent. If you go to the next slide, I have an example of that. This is Charlotte, North Carolina, one of our popular markets. And you can see Kannapolis there in red. That's a suburb of Charlotte, which is very commutable to downtown. But what we're seeing, our team there is also selling and renting very quickly houses in Salisbury, which is kind of far away. It's 43 miles away from downtown Charlotte. So under normal conditions, a 43-mile commute would be too much to do every day. But under the hybrid work model, where you work, from home most of the time and maybe go into the office once or twice, it's not that bad. So this hybrid work model is enabling for markets and suburbs like this to become more appealing for buying and for renting. And in this particular case too, there's the added benefit that Salisbury is halfway between two major job centers. You could have a couple where one spouse commutes south to Charlotte and the other spouse commutes north to Winston-Salem. So we're seeing this a lot across our network. All right, final question, are we in the bubble? The short answer is no. Just a reminder, we define a bubble as a rise in asset prices not justified by economic fundamentals. And as we reviewed on the previous slide, the fundamentals right now are very bullish for housing. The combination of 72 million millennials plus a shortage of inventory plus low interest rates adds up to a perfect storm for housing. In addition to that, the job market is very strong. There's only 3.9 million unemployed and 10 million job openings. Where I live, everywhere I go, I see signs that say help wanted. I don't know if you're seeing the same thing, but the job market is very strong, which is also bullish for housing. And then finally, a word about the forbearance programs. During the early days of the pandemic, a lot of homeowners and property owners were not sure they could make their payments, so they went into forbearance programs where their monthly payments were delayed. According to the head of the Mortgage Bankers Association, 75% of those are just resuming payments now and getting back to normal. And the other 25% are having loan modifications done on the loans so they can continue to stay in their homes and continue making payments on a modified basis. And the other thing is that in the worst case, even if you have to sell your house because you can't make the payments, they have the option to sell with positive equity because of all the home price increases we've seen in the last year or two. This is exactly the opposite of 2008. In 2008, you could have a $200,000 mortgage and your house was only worth $100,000, so you're underwater. So what do? You put your keys on the kitchen counter and walk away, and the bank's left holding the bag. So that's not the case now. In the worst case, people can still sell their houses with positive equity. So this is nothing like 2008.
Yep.
So next slide. So the effect on investors, you can expect continued price appreciation in growing markets. And this is not a repeat of 2008. I know that's hanging over everybody's head, but if you look at the economic fundamentals, this is nothing like it was back then. So the final slide, I'll just summarize everything I went over. The outlook for 2022, interest rates are likely to creep up, but not enough to cause concern. Housing prices are likely to continue appreciating, though not as much, not as hot as 2021. Unfortunately, COVID isn't going away, but everyone is learning how to deal with it and work around it. Larger homes further from the urban core will be in demand. And lenders may wind up tightening borrower requirements in the future, although it's not started yet. And bottom line, we're not in bubble territory. I personally think that if we could fast forward 5 years, all of us will look back and wish that we could have bought more houses back in 2022. That's my prediction.
Yeah.
So, of
Yeah.
course, anything can change. I mean, China could invade Taiwan tomorrow and all this could change. But, you know, as of right now, this is the lay of the land as we enter 2022.
Right. Exactly. No, well put. And do you think, you know, and you touched on this earlier, Joe, but like it says, you know, lenders may tighten borrower requirements, and you know, do they even factor in the fact that that's going to, you know, hurt the housing market? I mean, what's the justification for tightening the borrower requirements?
Well, the cause of that is if this mandate goes through, and then if a lender is going to lend to somebody who may lose his job because he's not vaccinated, that throws a monkey wrench or another variable for the lender to consider.
Right.
So for the 30% who are not vaccinated, that might be an issue. For the other 70%, it shouldn't be an issue.
And actually, Jeffrey writes in and says, check the news, the Biden mandate was struck down today. So,
Excellent,
yeah.
at least for lenders.
Yeah, exactly. That probably makes more of us happy than not happy. So that's good. So I neglected to mention that we will be taking questions periodically if they're appropriate when they come up during the show, but we're going to save most of them for the end. So if you go ahead and just enter into your GoToWebinar control panel and ask any questions, which a lot of you already have, including the one about the Biden mandate, we will get to them most likely at the end. And John asks, can we get a copy of Joe's slides? Well, we will archive this on the site. Usually takes 24 hours or so. So you can always go in and just watch it again and again and again, or do screenshots or whatever. All righty. So moving on here, rising rents.
Okay, this is me. I was really inspired by this topic because I feel like it's the glaring elephant in the room, at least for me recently. As a lot of my leases have come up on lease renewals, I find myself just consistently shocked at, especially for my Florida properties, how much rents are going up every year. And I recall at the beginning of 2021, us kind of internally on calls and one of our colleagues kind of saying that, you know, he had been seeing articles and reading data that the rent hikes are next. You know, we had started to already see runaway home prices, and we knew that's a leading indicator of where things are heading. Rents follow closely behind, and I kind of feel like clockwork. It's exactly what we saw. So I put together some points here to just kind of demonstrate and illustrate some of what we've been seeing with those rising rents. If you can go to the next slide for me. So CoreLogic, who is a great data source that we reference all the time, aggregating a lot of housing data that influences builders and developers and investors, of course. They've been really on the data here and releasing their Q4 information, you know, slowly. Some of these stats are pulled from their Q3 overview, but the bottom line is we are seeing record-setting rent growth. Summer of 2021, rent growth grew at its fastest pace since 2005. According to September 2021 data, national average rent increase is up 10.2% year over year from only 2.6 the year prior. So again, that fits kind of perfectly with what we were kind of forecasting, I think, at the beginning of last year. If you go to the next slide, I pulled some of their graphics just so you can see this illustrated. This is the National Single Family Rent Index for year-over-year percentage change. So it just shows you here 2021, the numbers just taking off the chart. And you can see the orange line is the index. That's that average that it was giving us. But I like that they break out the different tiers of rentals. So we look at what did lower tier rents do relative to kind of the medium tier and then the high and super high tier rents. And if you see that little blurb there, low end rent prices, which I would say predominantly is kind of where we choose to stay. We like to stay at the median or just below the median home values and median rents for the markets that we're in. They're up 8.3 nationally compared to high end rents, which are up 11%. And then if you go to the next slide, they cherry picked a couple markets to kind of illustrate the year over year change. This is not like a top market list. This is just, you know, some key markets that we like to look at. Huge year increases in Miami, up over 25%. I was pretty proud of the Boston stat here because they had an accompanying chart of showing last year relative to this year the rent increases, and Boston went negative in 2021 and then back up positive 4% in 2022 and in 2021. So I was proud of myself because I rented the dip when I was in Boston. But the thing that I think this really illustrates is that rent growth is highly local. And so we can't look at national, 10% rent growth and make our decisions based on that. Clearly, we have to kind of hone in, look at the local economic drivers, look at the local demographic trends, and let that inform our purchasing decisions. So keep that in mind. Rent growth is highly local. It will vary market to market. From my own portfolio, again, I said I noticed the most significant rent increases in my Florida properties. I saw rent increases across the board. I think every house that came vacant, it was, pretty significant rent increases, but particularly noticeable in Florida. This is, I think, the most important thing you have to consider. While we could look at the home prices growing and say, okay, rent growth is maybe a lagging indicator, what we cannot expect is that rent growth happens in lockstep with appreciation. That does not happen. Rental demand and housing demand, there are some demographic data that I think affect both or let us kind of predict both. But just because your home value went up and your taxes went up doesn't necessarily mean you get to hand over all of those expenses to your tenant, but just in a free market economy, you can expect to get to hand some of those over to a tenant. So if you go to the next slide, I plucked an example from a RealWealth property team. This is one of my favorite areas right now for investing. I've picked up a couple in this area here recently and have got a contract on a couple more. And I've just, full disclosure, like I'm really hot on this area. And so I've really been kind of watching what it's been doing since some of our teams first started promoting this area right at the onset of COVID. I think the first time that somebody was really highlighting this area to our membership was in April, because I know I was locked in my house watching our daily webinars when they first brought this inventory to us. So I brought some of those numbers here so that you can just see what we've seen over time. In August of 2020, this 4-bed, 2-bath house in Southwest Florida was priced at $225, and the rent projections on it were $1,650. Fast forward 1 year, August of 2021, the same house, a 4.2 in the same area, is now selling for $295,000, and the rent projections are up to $1,950. So I did the math here for you so that you can kind of quantify the percent changes here. That's a 30% increase in the purchase price and an 18% increase in the rent prices. So again, it's not in lockstep, as you see, but certainly if you were someone who contracted this back in August and you closed on it a year later, your pro formas are looking pretty awesome with rents going up to $1,950, probably kicking yourself for not buying a dozen of them, if only we had known. And then this isn't a perfect correlation because, again, that was a 1 year over year there from August 2020 to August 2021, but I went and pulled we have today in this market. So this is removed from that last figure there, but the same house today you can contract for $1,350. That's up an additional 6.7% in just 5 months. But look at this, the rents are already up 11%. So it tells us that maybe the growth rate is starting to slow a little bit. I think 2021 was the gangbuster year for a lot of people. Don't know for sure where it's going, but as Joe said, I think it's reasonable to assume the growth rate might slow a little bit from the equity side. But look at the rate of the rent growth. It was lagging and now it's catching up. So don't look at this slide and assume that rent growth will continue like this. No one knows that for sure. But this can help you quantify that opportunity cost, Ben, that we talked about earlier.
Right.
And it allows you to see, like, if you weren't satisfied with the little cash on cash return, I mean, because I bought one of these in August, the cash on cash return on that first one was not that impressive. I think it was 5 or 6% on paper. If I had just passed on that because I could get something with, 8% cash on cash return in Ohio instead, I'd be kicking myself for sure because it definitely, I never saw that low of cash on cash return. So
Right.
if you go to the next slide, Ben, what's causing this? Why is this happening? I think the buzzword of the year for everyone is inflation. How many conversations have you had about inflation over the last week? I feel like I've had at least 4 or 5 with just my personal friends and family. I think, just today they announced that the year-over-year inflation rate from December 2020 to December 2022 is now 7%.
Wow.
Which is I think it's hitting everybody especially hard because we all, or a lot of people, just got their annual pay raises. And usually employers are keeping you up with inflation. And this year, I have heard very few people say that their employers gave them a pay raise consistent with 7% inflation. But I want to highlight, like, inflation is one of the reasons that we buy real estate. It's great that it appreciates, but inflation really works to our benefit. And I think in my previous classes that I've taught about the 5 ways that real estate pays you, I probably hyper focus a little too much on the act of inflation on the value of the home and the act of inflation on the debt that you have, right? Because we know that the debt that you owe that lender is eroding with inflation. But what I probably didn't highlight enough is the effect of inflation on the rent prices. Maybe your employer didn't pay raise in current with inflation, but if you bought real estate, if you had a bunch of rentals, your rent increases probably exceeded the inflation rate. At least they did for me on just about every one of my homes. So I'm seeing this as a way to not just hedge myself from the debt perspective and from the net worth perspective, but from my income. Like, if things are across the board getting more expensive, my rental properties are going to be what makes sure that I keep up with how much more everything is costing these days.
Yeah, and
go ahead, Ben.
Can I just read this appropriate question here? Ben writes in, not me, a different Ben. Regarding rent increases, are your PM affiliates rising rents significantly for existing tenants or only for new tenants after turnover after a vacancy?
This is a great question, and I'm going to get to it because I have kind of an implication slide, because I do want to talk through some of that, because I think there's some things we need to be aware of when it comes to raising rents if it's vacant and raising rents if it's occupied. So we'll get to it, Ben, other Ben.
Okay.
So what is causing the rent growth? It's the same supply-demand imbalance that's pushing home prices up. COVID accelerated a lot of these demographic shifts that were already happening. There is, like Joe mentioned, the largest age group, the largest cohort of the largest age group in the United States is entering prime home buying years. They're in household formation years. And we know it's very hard to buy a house. So heck, when I tried to buy in March, there was a dozen offers on every house I put an offer on. So where are those other people who didn't get the house that I made an offer on? Where are they living now? I mean, maybe they just perpetually kept bidding and were never able to move, but chances are some of them had to go and rent something. They couldn't get into the housing market. So there is the same kind of scarcity when it comes to available rental homes. This has also been glaringly obvious to me when I kind of manage my own portfolio and I look at, when I have all my homes claimed on Zillow, so I can go and just click on each of them and look at what they're estimating for Zillow rents and home values. And so I like to kind of look at how many rentals are available around the general area where my homes are. And it's like, oftentimes there's maybe 2 or 3 other options within, a 5-mile radius of my house. Again, CoreLogic data, Q3 data said that rental vacancy rates are at an all-time low at only 5.8%. So this supply-demand imbalance is pushing those rent prices up. There's just fewer things to buy, so you get to charge more. And then this last point, it very closely related here to inflation, I think. 60 Minutes did a segment, I think it was last week or maybe it was this week even, called the big quit. Some people have called it the great resignation. Joe, I'm seeing them too here in Texas. The hiring signs are everywhere. The Chick-fil-A is starting hourly pay at $18 an hour. Chick-fil-A. And so it again goes back to the supply demand. We do not have enough people in the workforce, and it's particularly hollow in the lower income jobs. It's hospitality, it's transportation, it's healthcare. And so what's happening is, these employers and these lower price points are having to compete for the labor by offering higher wages. So this, I think, kind of speaks to people who are wondering, like, can people continue to afford this rent growth? And I think if you're renting to this lower end rent product, the answer is yeah, I think they can. We're seeing the highest wage growth happening in those lower income jobs. All right, if you go to the next slide for me.
All righty.
So go. Implications for investors. What does this mean? The first one here, I've already kind of mentioned, you've got to closely monitor the supply of the rentals around your investment property. Property managers should be doing, they are the ones local, they should have a really good pulse on how many competing rentals are on the market at the same time yours is, but they don't care about it like you care about it. And I can't tell you how many times over the last year, I have been monitoring for the whole year kind of what rents are doing in the areas where I have rentals. And when it comes vacant, the property manager will say, we recommend X. And several times I felt like it was low compared to what was actually on the market. And so I had a couple times to, kind of push it a little bit and say, I don't know, there's nothing else that's this quality in this area at all from what I can see. So let's be a little aggressive in our pricing. We know if you're getting a record level of applications for each one of these homes, I can probably push my rent a little bit and draw a higher quality tenant. So I think this is really important to monitor. A lot of the online databases that we've recommended previously, like Rentometer, for example, they're getting data over a period, but that might not be enough at how fast rates are going up. You might need to look at the last 2 or 3 months and set your rents based on that rather than the last 12-month data. The second one here, be patient for the right tenant. There are more tenants looking for housing than there are rent houses available, and you have one of those rent houses. So now is not the time to lower your standards to put a tenant in the property. I know we all get kind of nervous when our rentals are empty, right? But I think now more than ever, you can be patient for the right kind of tenant, the right tenant. You don't have to make concessions on credit scores now. Again, there's some variation here, just market to market, but generally speaking, I think now's the time to hold tight and don't lower your standards. The second one is consider avoiding lease terms that are longer than 12 months. I know a lot of times property managers suggest, offering a discount if someone was willing to lease sign a 24-month lease as opposed to just a 12-month lease. I personally feel like this is a bad time to be doing that. with rent increases happening as quick as they are, I'm really not interested in committing to you at that price for much longer. Of course, case by case, there could be a scenario where it would make sense to do that, but I would suggest you just sign 12-month leases. So this kind of leads me, I think, to the point that I wanted to make for Ben's question, and that is deciding when to raise your rents with a tenant who's already there. If you have a good tenant who's taking good care of the house, always made rent payments on time, you don't want to get greedy about raising rents, right? Sometimes it's just not worth it. If you want to go bump up fully to the market rent, they could be just so ticked off that you would raise their rent that much that they want to leave. And so I do think you have to have balance there and be respectful of the fact that, like, this is someone's home and they have a family there. But that being said, you also have to consider what other options do they have? And this has to keep increasing accordingly with my expenses. I have one kind of glaring example of this in my portfolio. I had a property in Cleveland, and this property is probably the highest touch property that I have in my portfolio. I frankly hate it. There's just a lot of maintenance that has to go into keeping this 115-year-old house going. But the rents went up almost 20% from 1 year. And I couldn't believe it. And this was a number that the manager came to me with, not one that I, kind of came into on my own. And I didn't have a great tenant in the property. So I wasn't like super like into the idea of retaining her, but I did the math and I looked at, okay, if she leaves, I'm gonna have to do a lot of work to get this house looking good again, to re-rent it at that higher amount. But the rent increase was so substantial, I decided it was worth the risk. And she wasn't a tenant worth retaining anyway. So I made the choice to kind of say, hey, here's the market rent. I knew there was nothing, and I didn't go up to the full amount. I did come down, a little bit to make it worth her while. But I knew enough to know she can't find anything else in this school district, in this area, that's anywhere close to what she's currently renting at. It doesn't exist anymore. And ultimately, that tenant did decide to leave because she thought she could get something cheaper somewhere else, and long story short, she had a harder time than she thought being able to find something. So I think it's just a really it's a time where you've got to manage this. Don't expect a property manager to do that kind of math for you when it comes to deciding a lease renewal, whether it makes sense to or not. You still want to kind of pencil out what a tenant turn would cost you relative to how much more money you could be making with an unknown tenant at that higher rate, and then you kind of decide if that risk is a risk worth taking. And then this last one here, this I think kind of goes a little bit into what you were saying, Ben. Consider that cash on cash returns are likely to grow after your first lease term. You have to decide how much you're willing to speculate or bet on the fact that cash on cash returns will likely go up. I had to coach a client through this last week. He's just really unsatisfied with the cash on cash returns of some of these new construction homes. They're not great in year one. And he kind of got to a point where he's like, they're 1% lower than I would like. And I'm like, okay, well, let's reverse calculate what that means, okay? How much more would that rent have to be for you to hit that one more percentage of cash on cash return? Are we $30 to $50 off? Is that all we're off by? And in this scenario, yeah, that's all it was. If rents would go up $50, it'd be the number I'd want to see. And I'm like, okay, well, if you're making the decision, if the decision is a no because of $30 a month, based on the way rents area previously, I think the emphasis is on the wrong syllable. You're passing on this deal that will go up $50 over the next year. So just consider that. I'm not telling you to speculate 100% on every investment, but it is investing after all. So there's a certain amount of speculation that's always happening. You just have to decide how much you are willing to speculate. And if it's for 1% cash on cash return, I say go for it.
Yeah. What did he end up doing?
I feel like he's there. I need to check in with him this week and find out if he went on it. But the last message said he was feeling a little bit better after being kind of coached through it. I hope he bought it.
Right. And then here's a question. Do you recommend going month to month after the conclusion of the lease, or just re-upping for another 12-month period?
I think, obviously it's case by case. It would depend on the tenant situation, but generally right now, I don't really love month to month either.
Yeah.
I don't know. What are your thoughts? Do you have any thoughts on that, Ben?
Not really. I think I'd rather just, re-up for another month, because just like the tenant doesn't want the other shoe to drop and suddenly they're told they have to get out in 30 or 60 days. I don't really want to, at the worst possible timing, be told that, hey, I'm leaving. It's
Right.
like, it's kind of like, for a planning standpoint, it's nice just having that month, that 12-month period. That the place is most likely, unless they break the lease, going to be occupied. So
Right.
I just think for planning standpoint, I'd rather do that. But,
yeah, for a while during the eviction moratoriums, I would have said yes, because having an expired lease or not having a current lease was your only way to get somebody out of the house during the moratorium on evictions. But now I feel like I probably would prefer to just have a new lease term.
Yeah. So
All right, I think that's it for me.
That's it for you. Okay, Aristotle, you take over.
Yes, looking at the bigger picture. So I'm going to try to get through this quickly because we're already approaching the hour here,
That's okay.
the 1 hour mark here. So, I wanted to talk about the big picture. So basically, you can go ahead and go to the next slide here. Just don't just look at one asset or one aspect of real estate investing. Look at multi of them. So I call this a multi-dimensional asset class. So income property is a multi-dimensional asset class, right? So you've got cash flow, we talked about that. You got appreciation, you got depreciation, and that does not mean that the home goes down in value. I'm not talking about that. Tax benefits, leverage, and hedging against inflation. So I'm going to talk quickly about all those. And like Jerry Maguire says, show me the money, right? So, and in some cases, you will see the money every month, but then you will also see the money every year when you do your tax returns and so forth. So let's go to the next slide here and talk about these different aspects here. So cash flow, don't need to talk too much about this. We all know what that is. Kind of dovetailing on what Leah was saying and Ben were talking about how that one investor was so cautious or so upset about the cash flow that he was not getting. Cash flow allows you to save up more capital to purchase another property. So if your goal is to buy more property every year and use your capital from your properties, then yeah, you want to target a higher cash flow property. You don't want to target a property that's going to yield you 4% return, right? That's just going to take a longer time. Cash flow increases over time as rents go up. We just talked about rents going up, and they are going up everywhere. Cash flow can be a source of income at retirement age. That's kind of what my plan is. I'm 43, and when I retire at some point, I want to use my rental properties as retirement income. And so I do like cash flow for that. And then cash flow can help you be job optional. I know we talk about being job optional all the time. I talk to people on a weekly basis and they say, I want to quit my job in 5 or 10 years. And how do we get there faster? Well, targeting a higher cash flow property will help you get to that goal faster. So, all right, let's go to the next point here. So appreciation, right? So home values have historically increased subject to market cycles. By the way, Leah did a really good webinar about 2 months ago. I took some of these bullet points from her presentation, but she did a really good presentation on our YouTube channel if you want to go back and watch this about the different ways that income property can make money for you. So Leah, I have to credit you for some of these bullet points here. Gains are unrealized until you sell or use the equity. That's pretty obvious, right? But you do have appreciation and equity there in your house. Appreciation is speculative, meaning that it's a gamble. We don't know. The best way to look at what markets are going to appreciate more than others is going to be growth, right? Population growth and job growth. And if someone says, well, I heard Florida is appreciating. Well, where in Florida, right? I mean, there's so many cities, and I think there's over 450 metro markets in the United States. There's so many different cities, and so you have to be really pinpointing exactly where. I mean, so it is speculative, but if you know and you work with our teams that do offer properties in these higher appreciation areas, then yes, it is going to be easier to get. And then appreciation allows you to get the equity to build up your portfolio. So say, for example, you want to do a 1031 into a larger property. I know I talk to people who maybe they want to buy an 8-unit or a 10-unit, or they want to have a whole slew of apartment properties, but they have 0 right now. A good plan of action would be to try to buy a property. Again, this is speculative, of course, but buy a property in a high appreciation market. And at some point, 5 years on the road, maybe you can do a 1031 exchange, a tax deferred exchange where you defer the tax, or defer the gains, and you roll it into a fourplex. And then you do that over and over time. And before you know it, you have a larger and larger property. It does take time. And of course it is speculative, as we mentioned. So, but that is another way to get into a larger property. All right, next slide, depreciation. So I am not a tax expert. Okay, I'm not giving you legal tax advice or anything here, but I'm going to talk to you about real quickly about what depreciation is. If you don't know, the IRS allows you to depreciate a residential income property for 27.5 years. So what that means is that the IRS says, okay, you own an income property. There's the land, okay, and then there's a structure in the house. The land never goes to zero, okay? You can buy land and it never goes to zero. The structure, you're able to depreciate it, meaning you're able to write off things because of the wear and tear of the house, right? Things are going to wear down. So the IRS sees that as as a depreciating that part of the property, or the part of the income property, which is fantastic. Now, you don't have to take it, but I do it every year. I'm sure you guys do it too every year, but I recommend you do take it. And as my second point there says, your accountant can help you determine how to calculate this depreciation. I don't do it. My accountant does it every year, but I do take it every year. And with enough properties, your tax liability can be much lower. So I give the example of a $200,000 property could allow for a $3,000 to $5,000 depreciation per property. So, and again, that's just an estimate. But imagine if you had 10 of those or 15 of those houses, and you could basically lower your tax liability. So if you are in a high income tax bracket and you live in places like California or New York or somewhere where the income tax is just crazy and you're getting taxed, owning some single family homes is a great shelter for that. You can deduct a lot of things from that. Just like owning the business. If you were to go out and buy a Subway restaurant or a laundromat, you're going to be able to deduct and depreciate those things too. An income property is no different. And then you do need to recapture the depreciation when you sell. It's not a lot, but you do have to recapture that according to the IRS. So number 4, go to the next one here. This one is tax benefits. So this is a big one, right? I know a lot of people, including myself, that buy rental property for tax benefits. Again, everyone wants to buy for cash flow, and some people call us and they say, I want to know where the highest cash flow markets are, and they don't really know why. But there's other things like tax benefits, right? And we've done a lot of webinars with our preferred tax company and legal company, Anderson Advisors. You can find that on our YouTube channel as well. We've done lots of really good tax webinars with Toby. But the first one is mortgage interest. So you can obviously deduct mortgage interest. You know, on a $150,000 loan amount, you're not going to be able to, you're not going to deduct $1,000, but it does help if you have mortgages. And that is actually another reason to have a mortgage, is for mortgage interest deductions. You can actually deduct your property taxes on your income property. You can deduct your insurance, okay? People don't know that. You can actually, and again, I'm not a tax advisor, so seek out your accountant for information, but this is just what I've been told. You can deduct insurance, and then you can, of course, deduct your operating expenses. So things like your property management fee, your repairs, your travel, your internet, your cell phone, anything that you're using to conduct your property management. Even if you have a property manager, you can deduct all those things. So again, a huge benefit rather than getting into something else that doesn't offer tax benefits. Number 5 is leverage, I think. Yeah, leverage. So this is a big one. So people buy real estate because of leverage? Well, somewhat. So using other people's money, right? You hear that term quite often, and that doesn't mean just getting free money. You have to get money and you have to qualify for it. But other people's money is referring to banks or seller financing or private money or hard money. Leverage is a huge thing because you want to go buy crypto. I don't think you can buy crypto by financing it or getting a loan for it. Not that I know of, I could be wrong. I do invest in crypto, but I don't have any loans for it. Maybe you can get loans for like index funds or some things like that. But if you're, your traditional IRA or 401k, you're just going to pay cash for those stocks. So you can't leverage that. So that is a huge benefit to buying real estate property or income property. And it allows you to purchase more with less of your own capital. So 20% down is what the minimum is for a single family rental, 25% down for multifamily. Then you get into commercial properties, 30 to 35% down. But imagine that you're putting 20% down and the bank is taking 80% of the risk. So if you have to walk away for whatever reason, you only got 20% in the game. That's amazing. I don't know any other asset that you could do that. And it is less risky because the banks take most of the risk, like I said. So should you lose the property? So I look at that as a huge factor of buying properties, that the fact that you can leverage these properties. And number 6, hedge against inflation. We just spent a little bit of time talking about inflation, so I'm not going to spend too much time on the nitty-gritty about inflation. You kind of know what that is. But the banks are willing to give you a fixed rate mortgage for 30 years while the value of the dollar decreases. So no matter what the market cycle is, you lock in a 30-year fixed rate. Like Ben was saying earlier in his first presentation, he didn't care if his house went up or down. He had a fixed rate and he was paying the same amount roughly. Now, give or take, taxes are going to go up. Insurance is going to go up a little bit, but your mortgage is not going to go up, which is great if you get a Fannie and Freddie loan. As inflation increases, so does the value of the dollar. And if you're keeping pace or beating inflation, I say you're winning the game. That's a huge thing. If you go to the next slide, I think I have a little quick story on there. Yeah, so this is interesting. You might have seen this before. So two friends are camping in the woods when they spot a bear running at them. And the first friend gets up and he starts running. He just books it, right? And he gets away from the bear. He's running. The second friend opens up his backpack, takes off his hiking boots, he puts on his running shoes, and he starts stretching. Are you crazy? The first friend shouts. You can't outrun a bear. I don't have to outrun the bear, says the second friend. I just have to outrun you. So why am I saying this to you? Well, what I'm saying is that you don't have to own 100 properties, although we would all love to, but you just need to keep pace with inflation, beat the government, win the game, and you're going to be ahead of everyone else. That's how I look at it. So, and I think I have a quick summary. The last slide is just a quick summary. So yeah, long-term buy and hold investing is not just about cash flows, you can see. So don't just look at the cash flow, look at the big picture of things. Okay, that's the whole point of this presentation, really, this whole webinar. When analyzing a property, try to look at the big picture. Think about generational wealth and how your kids are going to benefit. So yeah, you might only be getting $150 a month in cash flow or $50 a month in cash flow, but what about in 40 years when you pass on your kids? Your kids are going to benefit hugely from that. If you don't have kids, well, maybe adopt one, or I don't know. Maybe you have a great cousins or something, right? Or nephews and nieces you want to give your properties to. And if you're in a high tax bracket, owning rental property gives you a lot of benefits besides cash flow. So if you're a doctor or you're an attorney or you make a lot of money and you don't have rental property, you got to get them for the sake of lowering your tax bracket. So that's all I have to say from my presentation. I rolled through that pretty quickly, but Ben, if you want to talk about what's next, that'd be great.
Sure, absolutely. So it is a little bit after 4, so no social penalties need be paid if you need to check out. And like I said earlier, we will be recording this. We are recording. We'll be archiving it on the site. But we've got a boatload of questions here. I keep looking over at them. We've answered a few of them, but I'd like to have a little bit of Q&A. So we'll hang out for another 10 or 12 minutes here. But in terms of what's next, just don't let fear of missing out or fear of taking action set in. Determine your next step and just take it. If you're ready to invest, you're like, okay, enough talking, enough, ruminating over this. Just contact one of us. Whenever you join RealWealth Network, you're assigned either Joe, Aristotle, Leah, or myself, Ben. Contact your investment counselor or the property team in the market you're interested in. You don't have to go through us. You can go directly to them if you know, like, hey, Tampa's my market, Indianapolis is my market. Sometimes people like to schedule a time with us just to kind of get we're not trying to sell you anything, so we're neutral. We have our opinions, so we're not neutral in that respect, but to kind of compare X to Y, market Y to market Z, or just be as a sounding board. That's what we're here for. If you're not ready to invest, everything's on our website to educate yourself. It's not just our website, there's a million other websites as well, but we think we put a pretty good package and a pretty good website together, in that if you're interested in, I don't know, Tampa and Indianapolis, you're like, okay, I'm going to ignore everybody else and I'm just going to go onto RealWealth. I'm going to log in and I'm going to check out the Indianapolis page and I'm going to check out the Tampa page and I'm going to compare the sample properties. I'm going to watch the webinar for both of them, see which mentality and which philosophy I maybe sync with better, or what, in this market, maybe just go along with both of them and reach out to both of them and just buy whichever one comes up first. There's a bunch of different ways to do it, but if you're not ready, educate yourself. If you are ready, just go onto the site or contact us. And let's take some Q&A. And hey, Joe, you still out there?
Yeah, I'm still here.
Okay,
I was
cool.
on mute, but I was here.
No problem. I wanted to ask you, do you, because we've got a couple questions here about migration trends, and I think you'd mentioned like you were going to talk a little bit about that. Like, is there anything that stands out in terms of where people are moving to or from?
Can you make me the presenter?
I don't know. Maybe Jill behind the scenes can. In fact, I think she's doing it.
Hey, Ben, I just want to say too, migration trends. If you missed Kathy's, that's a great picture. If you missed Kathy's webinar last week with Logan, he did a great job about that. He had some great slides on where, U-Haul migration, all this stuff. So that's a great one to reference
Perfect.
to.
And do you know, Aristotle, where we can find that?
It's not
It's
on our
on YouTube.
site. It's on YouTube channel. I always keep saying
Yep.
YouTube. It's on your YouTube channel, I believe.
Yep.
Well, you can go to the U-Haul site too. They publish every January the migration, where people are moving from and to. So can you see my screen?
Yep, sure can. Thank you,
Right,
Jill.
here's a tool I use that's by Redfin. It tells you where people are moving from and where people are moving to. So here's origin and here's destination. So if you're interested in migration, come here. I'll just pick Charlotte because it starts with a C and it's close to the top. But you can see in 2020, Charlotte passed San Francisco as the 15th largest metro in the country for the first time. So I say, where are these people coming from? And it's unsurprising. The answer is they're coming from banking centers. 11.6% of the people moving to Charlotte are coming from New York, Washington, LA, Bay Area, and so forth. So you can see where people are moving from and moving to. It makes sense because Charlotte is the second largest banking center in the country. So when people are moving there, basically all these high-paying jobs in New York are moving to Charlotte, and so that's bullish for the Charlotte market because these are people who are making high incomes. The bank's not going to send a cashier or a teller to Charlotte. They're going to send their investment bankers or their IT people there. So you can use this tool depending on what markets you're considering to see where people are coming from and get an idea of what's driving the market. This isn't well known, but last year the population of the United States was flat for the first time in a long time. It didn't increase. So population growth is one of the main drivers of real estate because as the population grows, then the demand for housing goes up and rents go up and property values go up. So any population growth at a local level is going to have to come from in-migration. So it's important to understand the migration patterns. And it works the other way too. We could say, where are people moving to? Like we heard a lot in the press that everyone's leaving California. So let's see, people who are leaving LA, where are they going? The usual suspects, Phoenix, Las Vegas, Seattle, and so forth. So by playing with this from and to section here, you can get an idea of what's going on migration-wise and get some insights about what's happening in your market. This URL is not too user-friendly, but if you just Google Redfin data migration tool, you can find it. And it's updated every quarter, so it's pretty current.
Nice. Anyway, all right, let's see if we have any other, we have quite a few other questions here.
Paul asked a good one here, Ben. He says, any insights on property insurance? We're seeing big increases this year, even faster than home values. Well, I haven't noticed my insurance rates going up astronomically. Has anybody else?
No, mine actually went down. I shopped around actually last week and I'm saving like $250 on my property per year.
Yeah, I mean, I'm based here in Florida, and insurance companies hate Florida for obvious reasons. You know, these hurricanes come and wipe them out, and they're just like, you know what, we're not even going to write in that state anymore. And the ones that, you know, and then they start looking for reasons to drop existing providers. And I have this habit of me and an investment friend of mine, we like to buy like St. Petersburg older stick homes that, you know, we can get, you know, that are ugly and we can kind of fix them up and stuff. The problem with older stick homes, they're not in flood zones, but it's, I mean, like I have this one that I'm actually closing on any day now. It's like 1,800 square feet. No, it's like 987 square feet in the front property, and there's a little back property that's like another 400 square feet. And, you know, it's not in a flood zone. It's not perched precipitously on the edge of a cliff or anything like that, but yet it's going to cost about $5,000 to $6,000 a year just to insure this thing. You know, it's just really. And I've got you know, a couple different quotes here, and I'm just, you know, I'm going to have to decide before we close which one I'm going to do. But it's like they're both horrible. And then I had another property in Jacksonville that I bought way back when through our Jacksonville property provider back in 2014. Just out of the blue, sorry, we're dropping you. No reason, we're just dropping you. Never made a claim, never did anything. I'm being punished because I own a house that's in Florida. And the replacement company, People's something, they're like, well, we'll insure you, but you know, there's a couple cracks in the driveway. We need to have you re-pour that driveway. There's a tripping hazard. And I was really annoyed. And I just said, nope, I'm not going to do it. Found somebody else who thus far, they've bound the policy and they haven't demanded I do any ridiculous thing like repair a crack in the driveway, which wasn't cheap, by the way. It's like ripping out a couple squares of the driveway and re-pouring it just to satisfy the insurance god. So I have seen, but I'm in Florida, you know, in like Ohio and more stable areas. No, I have not.
Yeah.
So let's see. Yeah, and Thomas says that's because the construction does not meet current code. Well, that's true. I mean, the house was built in the 20s.
The new builds don't have that problem. I mean, they're some of the cheapest houses to insure that I have right now are my new builds in Florida because they
absolutely. Thank you for clarifying. I don't want to like paint Florida with the same brush because I have a quad that's brand new, a couple years old, and it's much cheaper. So it's mainly because, you know, I'm buying these older things. But it just has blown me away, and I think that the insurance companies are looking for reasons not to insure them.
Here, I've got a good one here, Ben. I know it's hard to talk and look at the new question, so I'll help you out and you can find the next one. Charlotte writes in kind of a long comment here about how she's going through her first eviction in Ohio, and she's experiencing the court system being very slow because it's backlogged. And then at the same time, she's feeling like maintenance and vendor repairs are taking longer and costing more. Charlotte, I'm sorry you're going through that. It's not fun, but yeah, I think this is consistent. I have noticed this too. I've been through a couple eviction processes over the last year, and it's just depending on the municipality, some systems are extremely backlogged. So have patience, stick with it, lean into your property manager. You know, but yeah, and then same thing, maintenance. I've noticed maintenance, you know, markups seem to be pretty prevalent. Ben, I think you had a scenario of this over the last year. You had gotten a roof quote the year before or something, and then you got to the point where you needed to do the roof, and then of course the prices to repair the roof are significantly higher in today's market.
Yeah, well, I got the roof repaired, and got the roof replaced, and that was good. But then to get a new insurance policy, which I knew would be a little bit more because it was a full policy, whereas before I was cheating and getting one that excluded wind, because to include wind with the old roof, it was really expensive. And they came back, and this particular company was like, okay, but we're excluding any water damage. And that property is in a flood zone. So, and I have a flood insurance on it, you know, but it just kind of annoyed me. It's like, okay, I got the roof replaced so that I could get rid of this exclusion of wind policy. And now the policy I have is excluding water damage. So, you know, what is it going to take to just get a normal policy that will cover me for most normal things that happen? And, you know, you just at a certain point, because I get a headache when I examine all these different declaration pages and you know, there's so many, then there's the standard policy and the special policy and how much your deductible is. And you just go, oh, fine, you know, I'll just take it. But yeah, I'm not real happy with insurance companies right now. They annoy me.
It sounds like your section should have been about insurance woes.
Yeah, oh well, I mean, you know, I mean, to their credit, every time I've had an issue, I haven't ever had one of those battles where they refuse to pay and long protracted things. I mean, when I have had things, which isn't very often, but the insurance is paid, but it's just getting a reasonable rate, I think, in Florida on an older property is difficult. Hey, Deborah asked a question of you, AK. Which insurance company is Aristotle going with for the savings?
Well, real quickly, I try to avoid like the state farms and stuff like those because those guys are really expensive. I have a company. There's a company called Insight Risk Management. I think they're a broker, but they only do certain states, like 5 or 6 different states. So I know like Alabama is one of them, Indiana, Tennessee, and a couple other ones in the Midwest and South. So not everywhere. I don't know if they do Florida, but you can check them out. But yeah, I mean, I went from like an $800 a month, $800 a year policy down to like 600 or like 580 something. I was like, and it's the same exact amount, same liability, everything. I was like, wow. Now it is a commercial policy. I don't really know. That's a whole different topic, but it's a commercial master policy, not a standard residential. So I don't know if there's any really difference, but.
Right. Okay. All right. And give us the name again.
It's called Insight Risk Management. I don't know if they have a website. I think they do, but I can send, if anyone wants the information, I can send it. I think it's a broker that I use. I've used them for a while, but it's not like you're a big, not like a big insurance company, but they're a broker and they shop around different carriers and depending on where your property's at.
So David mentions, has anyone raised the security deposit to match the increase in rents? Yeah.
I mean, if it's renewing, I mean, if it's vacant and you're placing a new tenant, your security deposits are usually 1 month's rent, sometimes 2 months rent. So it should be based on the price of the rent. Now, obviously I don't think you can go back and ask for more money for the security deposit to renew with someone, but yeah.
Yeah. And
I see the security deposit is more about how much damage they can do to the house. So if they didn't have pets before and then they suddenly got a bunch of dogs, then that increases the risk, and then I would increase the security deposit for that reason.
Yeah, absolutely.
William wants to know rent hikes. Is there a 2021 percentage increase for Jacksonville? William, there's probably some good data on that maybe at CoreLogic's website. Anecdotally, I saw about a 10% rent increase on my units in Jacksonville year over year. Ben owns in Jacksonville too. Did you see about 10?
Yeah, that's the one that was rented for $10.65 for like the last 3 years. And finally, that good tenant is leaving, and they wrote me back and said, going rent is $1,200 or $1,225. And I wrote back that seems a little low considering they've been there for 3 years. And she wrote back and said, that's on the low side. We actually think it could be as high as $1,400. She was just, didn't want to overpromise and underdeliver. So, we'll see.
Again, don't just take your lean into your property manager, but don't take what they tell you as gospel. Like go and just verify it yourself.
No. What I found I wish it was better, but what I found is that if I punch in my address on Zillow, I don't want to over rely on Zillow, but then I just, I make it to where only the purple dots show, the prices, the houses that are for rent. I don't care about what's sold or what's for sale or what's on the market, just for rent only. And I just zoom out and I see what it is. And then I look at it and I wish there were more purple dots. There's not that many, which is good. But then I'm thinking, well, I don't have much of a comparison to come up with the price. There's only 2 dots within.
You got to look at the purple dots all year long, Ben. Don't just pull it up when it's vacant.
Yeah, because once it's rented, the purple dot goes away. I wish that there was a way to look at. There probably is. What are rents going for currently in the area? Not just what's for rent now, but what over the past 6 months. But anyway. So Daniel asks a question, how do you think about the normal rental properties and the Airbnb properties? Now that came in way like back 20 minutes, 40 minutes ago, 20 minutes after the hour. So I think he was talking about me, like what do I think about the properties that I have that are annual rentals as opposed to the short-term rentals? And I like them both. Is definitely more work with the short-term, because you're running a small hotel and I don't even manage it myself. But just yesterday, I get a $500 gas bill. And the only thing that's natural gas is this pool heater. So I'm like, uh-oh. And then I go to the rental manager and they didn't charge anybody for pool heat like they're supposed to, and I'm like, so then I call the pool guy. Could you go there and make sure the padlock is on the pool heater like it's supposed to? Nope, no lock on the heater. So I'm like, so there's a lock on it now, but it's just little things like that you wouldn't really have to deal with in an annual rental because the gas bill's in the tenant's name. So I don't have to deal with it. So it's more work. And it would really be more work if I managed it, which I don't from 2,000 miles away. But so I like them both. And I like I said in that webinar we did a while ago, I think it's good to have a little bit of each. It's just like it's good to have stuff in different locations.
Yeah, I want to acknowledge all of the people that are writing in about their success stories over the last year and couple years. A lot of people are seeing the same kind of stuff and seeing incredible cash flow growing and getting close to being job optional. That's awesome to see. We love hearing those stories. Maybe we end on this one. It looks like the last one that's kind of on a different topic. Jason writes in, what are your thoughts on selling one of my properties that I'm netting about $1,500 each month on and taking $650,000 of net proceeds and purchasing additional properties or possibly investing in some syndication, multifamily deals? He just feels like he's not getting the kind of return on that equity that maybe he could be getting elsewhere. Does anybody have any thoughts on that?
Well, I'll go. Well, yeah, you have to do the math, right? Look at other properties through our network and see what's cash flowing, because obviously the whole point of doing a 1031 exchange, if you do that, is to replace the same amount of cash flow, if not more, right? It would be kind of silly to go backwards, in my opinion. But yeah, you would just have to compare. But yeah, I mean, if the average property is cash flowing through our network $200 a month, you do the math, and depends on what the purchase prices are and everything. But it could be feasible to get into like a fourplex or something, maybe.
Right. I mean, I just did the math real quick for you, Jason. Like if you're cash flowing, if you're net $1,500 a month, I did real quick your cash on cash return. So just looking at the cash flow yield, clearly maybe it's a high appreciating market and you need to factor that in too. But just looking at cash on cash return, that $650,000 is only earning you 2.7%, which compared to a lot of the opportunities we have today is low, right? But the question is, where is this house? Maybe it's in a really high growth area and your appreciation just makes that low cash on cash return totally worth doing. The other thing you want to ask yourself, I think, is which is better, the devil that you know or the devil that you don't a little bit? You might know this house, you might really understand its quirks and stuff, and unless you're exchanging into all new stuff, you might be swapping it out for higher touch stuff, and maybe that's not that's not conducive to your quality of life right now. So it's a multifaceted decision.
I two quick points on that. First of all, another option is if you like the house and it's a good house for you, it's just you've got a lot of equity tied up and you're not utilizing it, you don't necessarily have to sell it and take proceeds and buy 6 more. Although Carl writes in on that last question, we just sold a $700,000 house and bought 6 single family homes, now making nearly 10,000 more. I assume that's 10,000 more per month. I don't know, but regardless, that's one way. But you could just keep that house, get a HELOC on it, use that HELOC money to put down payments on a bunch more, and then you kind of got the best of both worlds. You keep the original one, and then you use the equity to buy more. So I mean that's one option. And I only say that because I wish I'd done that a couple times rather than just bailing out of a house that I wish I'd kept.
Yeah.
All righty. Well,
Okay.
AK, did you have something to say? Did I hear you?
Nope. I was just saying nope.
Okay.
Agreeing.
Well, I think that about does it. We've pretty much gotten through all the questions here. There's a couple we avoided or I didn't get to because it was just a little too detailed, but I agree with Leah. Thanks. There's a lot of good comments on here and people reiterating what we've said. And I hope that this webinar was of value to everybody. Do you guys remember, was this the last slide? I think there was one more after this.
I think so.
Okay, let's go to it.
It's a thank you.
Oh, it's a thank you. There you go. And I just clicked through it. Okay. Well, so thank you so much for watching. I appreciate it. Thank you, Jill, for fixing that. We will archive this, as I've said now 3 times. Thank you so much. Thanks, Leah. Thanks, Aristotle. Thank you, Joe. And we'll do it again soon. Tune in, I think a week from today, we're doing a webinar with Orlando, and it's going to be me talking with Gene about properties in Orlando, new builds. So come back in a week and we'll talk then. And until then, thank you so much, everybody.
Bye.
Bye, guys.